A dangerous promise is luring millions of Americans into a financial trap. It starts with $100 and ends in bankruptcy. Legalized in 37 states, this billion-dollar scheme preys on the vulnerable, and no one is stopping it. Here's how America let this scam go legit, what you can do if you're trapped, and how to keep yourself safe. It starts with a promise of $100 or more, but it ends with millions of Americans trapped in a cycle of debt. It's being called legal, but many say it's robbery in disguise. So we investigated the $100 scam that's sweeping across America and why 37 states are letting it happen. Let's meet some people who fell into this trap. Jessica Vega, a nonprofit caseworker in Rhode Island, took out a $400 payday loan after college. She ended up trapped in debt for nearly a year, borrowing every paycheck just to pay the last loan. Sherry Shannon from Minnesota needed $140 to fix her car. She paid back $500 in fees and nearly lost her home. Maria Dichter, a retired woman in Nevada, borrowed just $100. She now pays $554 a month in fees. Her lender admits to charging 300% APR, and she's still stuck. And then there's a single mother who reborrowed a $300 loan 35 times over 17 months, paying $1,254 in fees. Or a teacher who had 6 payday loans at once and lost her home and car. Each story is different, but the pain is the same. A short-term fix becomes long-term destruction. But payday loans haven't always been such a big problem. Let's also add some of the cash advance stories too, since they're the same thing but digital and in an app. Plus they connect to your bank account directly, so it's even worse. When we think of scams, we picture phishing emails, fake IRS calls, or even street hustlers with the old guess which cup trick. But what makes the scam I'm covering today so different is that it's hiding in plain sight, with over 20,000 physical stores across America and 12 million Americans falling into the payday loan trap every year. Here's how the scheme works. Meet Sam. Sam is struggling financially and needs $100, maybe for groceries, a utility bill, or childcare. Sam doesn't have the best financial history, so his options are limited when it comes to where he can borrow money right now. But he remembers seeing a store that looks like this. You've seen them yourself. They have signs that say something like cash in minutes, no credit check, or loans up to $500 today. Desperate for help, Sam walks in and signs a contract that lets him borrow $100. At first, it feels like relief, until 2 weeks later, when he owes $123. That extra $23 might not sound like much, but it's the equivalent of a 600% APR, nearly the highest legal interest rate in the US. This is commonly referred to as a payday loan, which offers short-term cash, usually due by your next paycheck, and they come with flat fees instead of traditional interest. They're marketed as a quick fix for emergencies, but most borrowers can't pay them off in time. Research shows that around 80% of payday loans are rolled over, meaning borrowers can't repay them on time, and they need to take out another loan just to pay off their current one. Each new loan adds another fee, and the cycle continues. And here's the darker part. These loans specifically target low-income Americans. The average borrower earns $25,000 a year, and if they need $100 to survive, they have no margin for error. And unfortunately, the common result is that this $100 loan turns into months or years of spiraling debt. Payday loans and cash advance apps have been on the rise in the last 20 to 30 years. As states rolled back the interest rate caps, we saw tons of storefront payday shops pop up. It was like the Wild Wild West. And with the rise in smartphones, we saw tons of finance apps that made it easy to get cash right away. In 2010, the Dodd-Frank Act created the Consumer Financial Protection Bureau, aka the CFPB, to regulate payday lenders. But enforcement? Spotty at best. A 2017 rule that required lenders to verify a borrower's ability to repay their loan was repealed in 2020. Only in 2024 did the Supreme Court uphold the CFPB's authority, allowing it to finally enforce the two strikes rule, which limited automatic bank withdrawals starting in 2025. But here's the thing, the CFPB can't cap interest rates, only states can. As of 2024, about 20 states cap payday loans at around 36%, while 13 states and Washington, D.C. have made them illegal. In states that passed strong reforms, payday lending has sharply declined. For example, North Carolina's 30% cap has all but eliminated storefront payday shops. Yes, it's good. They've been outlawed in certain states, but another version of payday loans are still legal and have been trapping Americans for the past few years. I'll talk about the digital payday loans in a bit, but they essentially function the same as regular payday loans. The reason these interest rate caps effectively end payday loans is that the business models for these lenders rely on people not being able to pay back their loans on time. Researchers at the Federal Reserve Bank of Kansas City concluded that the profitability of payday lenders depends on repeat borrowing. And if you're in a state with a $15 fee per $100 borrowed, an operator will need a new customer to take out 4 to 5 loans before that customer becomes profitable. An analysis of North Carolina data found that 73% of lender revenue came from borrowers using 7 or more loans per year. Even though payday loans are packaged as 2-week loans, borrowers are actually indebted for an average of 5 months per year. Payday loans make their money off of fees, and it's estimated that the entire industry made $7.4 billion a year in fees, with $1.3 billion coming from Texas alone. In some states, payday loans are totally banned, like Georgia, which made it a felony in 2004. But even when disclosures are required, that hasn't stopped predatory pricing. So unless you live in a protected state, you're vulnerable, and payday lenders know it. And while most payday loans have traditionally been storefront only, they're making their way online. Well, sorta. Cash advance apps are very similar to payday loans. They promise fast cash when you need it, but they are also incredibly expensive, even though some market themselves as being interest-free. And just like a payday loan, there are countless examples of customers getting trapped in debt, and they have been sued time and time again. So while cash advance apps might have a different name, they essentially create the same problem. We did this video on cash advance apps in case you want to learn more. On the bright side, payday loans can be avoided, and the most financially vulnerable people in the country do have other options. Credit unions offer payday alternative loans, which are small loans at up to 28% APR with no hidden fees. Local nonprofits offer debt relief and credit counseling. Some may even help you repay your payday loans. Employers might even offer a paycheck advance, or they can call their utility company, landlord, or hospital billing department and explain their situation, with many offering hardship plans. We also have personal loans, which are considered by many to be a better option than payday loans because they offer more money and have longer repayment windows. A lot of people who have bad credit think they won't qualify, but that is not the case. CreditNinja works with customers who don't have the best credit and offers loans up to $5,000 that can be delivered the same day. To learn more, head on over to CreditNinja.com. Thanks for watching, and we'll see you in the next one.